Picture this. You open your phone at 7 in the morning, coffee's still too hot to drink, and the first thing you see is a push notification that says stocks just hit another all-time high. Again? For the 10th time this month, it feels like. The S&P 500 closed above 7,800 for the first time in history. The NASDAQ is surging, and every single financial channel is running the same two words underneath the ticker. Record high. And somewhere underneath all that green on the screen, a quiet, uncomfortable question is starting to grow louder in your head. Is this real, or am I watching the biggest financial mirage of my entire life build itself in real time? Meet Daniel. 31 years old, works in marketing, has about $40,000 sitting in a brokerage account that used to just track a boring index fund until about 2 years ago. Then he started buying individual AI stocks because everyone he followed online was doing the same thing and posting screenshots of their gains. At first, it felt like magic. Every company he touched seemed to go up. He bought a chip maker and it doubled. He bought a cloud company and it tripled. He bought a small AI software startup because a video told him it was the next Nvidia. And for a few months, it actually behaved like the next Nvidia. Daniel started checking his portfolio the way some people check their phones for texts from someone they like. Constantly. Compulsively. With a small flutter of anxiety every single time. Because somewhere in the back of his mind, a thought kept surfacing that he didn't want to look at directly. What if this is too good? What if this is exactly what people describe right before things fall apart? Now let's rewind for a second and actually look at the numbers, because the numbers are where this story gets interesting. In the middle of August 2026, the S&P 500 pushed past 7,800 for the very first time, driven by cooling inflation data that came in below what economists expected. A Federal Reserve holding rates steady, and a wave of AI-linked earnings that reassured investors their money wasn't being wasted. The index had already logged around 25 separate record highs in 2026 alone, on top of dozens more the year before that. Nvidia, the single most important company in this entire story, was trading around $219 a share heading into its most anticipated earnings report of the year, scheduled for August 26th. Analysts were expecting somewhere between $91 and $95 billion in quarterly revenue, which is almost impossible to say out loud without pausing, because that would represent close to a 95% increase from the same quarter 1 year earlier. Nvidia's data center business alone had already been growing north of 90% year over year. 58 out of 61 analysts covering the stock rated it a buy. The average price target sat somewhere around $300. This is not a small, speculative company anymore. This is arguably the most important single stock on the planet, and its earnings report has become something closer to a national economic event than a quarterly filing. But here's where Daniel's story, and honestly all of our stories right now, start to split into two very different paths, because underneath every one of those green candles on the chart, there's a second conversation happening, and it is a lot less comfortable. Corporate America is on track to spend somewhere between $770 and $800 billion on AI infrastructure in 2026 alone. Just the 5 biggest cloud and technology companies, Microsoft, Amazon, Alphabet, Meta, and Oracle, are collectively committing somewhere around $660 to $700 billion in capital expenditure this year, nearly double what they spent the year before. Meta alone raised its spending guidance to somewhere between $115 and $145 billion, an increase of up to 86% compared to the prior year. Data center construction spending in the United States has tripled since 2022 and is now on pace to outgrow general office construction entirely. Some analysts, including teams at Goldman Sachs, project that hyperscaler spending on AI could climb past $1.1 trillion cumulatively between 2025 and 2027. This is, by almost every measure available, the largest privately funded infrastructure build-out in human history. Bigger than the railroads, bigger than the interstate highway system, bigger than the original build-out of the electrical grid. And the question every serious investor is now wrestling with is deceptively simple. Will all of that spending eventually turn into profit? Or is corporate America building a $1 trillion cathedral for a religion that might not have enough believers to fill the pews? This is where Michael Burry enters the story. And if that name means nothing to you, here's the short version. He's the investor who famously spotted the 2008 housing crash years before anyone else took it seriously, a story that later became a movie. In August of 2026, Burry compared the unshakable positivity surrounding AI to both the dot-com bubble and the housing bubble, warning that the psychological pattern felt disturbingly familiar. The same unquestioned confidence, the same dismissal of anyone raising concerns. He pointed to something specific and structurally worrying, what analysts are now calling circular financing. Here's how it works in plain language. Nvidia invests billions of dollars into OpenAI. OpenAI then turns around and commits that money, plus far more, toward buying computing power from cloud providers like Oracle. Oracle, in turn, uses a huge portion of that money to buy chips from Nvidia. The same dollars appear to travel in a loop, showing up as an investment on one balance sheet and as revenue on another, cycling through 2 or 3 companies before landing right back where it started. Nvidia alone has been involved in more than 50 different venture investments into AI companies in a single recent year, many of which then use that very capital to purchase Nvidia's own products. Defenders call this efficient vendor financing in a capital-intensive industry where trust and supply chain security genuinely matter. Critics call it something closer to companies buying their own demand, manufacturing the illusion of a market that might not fully exist yet on its own. Burry didn't stop there. He also flagged what he called an AI debt explosion, pointing to the fact that 30-year Treasury yields spent 27 separate days above 5% in 2026, a stretch not seen since the lead-up to the 2007 financial crisis. Technology companies have been tapping bond markets aggressively to fund data centers, chips, power, and cooling infrastructure, competing directly with a flood of government debt issuance. Oracle's total debt climbed past $130 billion, with roughly $248 billion in additional lease commitments layered on top, and its credit default swap spread, essentially the market's price for insuring against the company defaulting, jumped by more than 300%, pushing perceived risk to its highest level in 16 years. The Bank for International Settlements published a warning of its own around the same period, cautioning that hyperscaler debt tied to AI construction is now growing faster than the balance sheets carrying it. A Bank of America survey of global fund managers found that a growing share, somewhere around a third to nearly half depending on the month, now view AI hyperscalers spending as the single most likely trigger for the next systemic credit event in financial markets, ahead of concerns about private credit or consumer debt. Meanwhile, OpenAI, the company sitting at the very center of this entire ecosystem, is reportedly on track to lose somewhere around $14 billion in 2026, nearly triple its losses from the year before, even as it has signed infrastructure commitments reportedly totaling more than $1 trillion over the coming decade. Its actual annual revenue is estimated at around $20 billion. Sit with that gap for a second. $20 billion coming in, over $1 trillion committed to go out over time. Now let's go back to Daniel for a second, because this is exactly the moment where his stomach starts to turn. He starts reading about how the 7 largest technology stocks, the so-called Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, climb to represent somewhere between 32 and 35% of the entire S&P 500's total value at their peak in 2026. To put that in perspective, the historical average weighting of the 7 largest companies in that index, going all the way back to 1957, has been roughly 17%. The previous concentration record, around 26%, was set during the energy boom of 1980 and matched again at the very peak of the dot-com bubble in March of 2000. In other words, more of the stock market's total value is currently riding on a smaller handful of companies than at almost any other point in modern financial history, arguably including the dot-com peak itself. And here's the part that should genuinely concern anyone with a retirement account, even people who think they've never touched an individual AI stock in their life. If you own an S&P 500 index fund inside your 401k because someone told you that's the safe, boring, diversified choice, you're not nearly as diversified as you think you are. A third of your money is effectively a concentrated bet on the continued success of 7 companies, most of them tied directly to the fate of artificial intelligence. Daniel starts to feel that familiar knot in his stomach again, the one that shows up right before he does something he might regret, except this time the question isn't whether to buy more, it's whether to sell everything and run. So he does what a lot of people do in this exact moment. He starts searching for someone to tell him it's fine. And he finds that too, because the bull case here is not some fringe, hopeful fantasy. It is backed by real institutions with real analysts putting real numbers behind it. Unlike most companies during the dot-com era, today's largest AI beneficiaries are not pre-revenue promises running on venture capital and vibes. Microsoft, Nvidia, Amazon, and Alphabet are established, profitable businesses generating enormous cash flow. Nvidia's trailing price to earnings ratio, even after its massive run-up, sits around 34 times earnings, which is actually a steep discount compared to its own 10-year historical average, closer to 62 times. Analysts at JP Morgan have suggested the S&P 500 could climb toward 8,000 if earnings momentum simply continues on its current trajectory. Goldman Sachs has described the AI build-out as a multi-year supercycle rather than a bubble in the traditional sense. Roughly 86% of S&P 500 companies beat analyst earnings expectations, heading into mid-August 2026, well above the long-term historical average, closer to 68%. And calendar year earnings growth for 2026 is projected around 30%. One analyst framed the entire debate in a single elegant sentence that Daniel keeps thinking about. A bubble doesn't pop because price-to-earnings ratios get too high. It pops when the earnings themselves stop growing. And right now, the earnings, for the biggest players at least, are still growing and growing fast. There's also a deeper, more philosophical argument that keeps surfacing, and it goes something like this. Every transformative technology in history has produced both genuine, lasting value and a period of extreme, painful speculation, and those two things are not contradictions. They're just two sides of the same coin. The internet absolutely did change the world, permanently and completely. And the dot-com crash still wiped out an estimated $5 trillion in market value almost overnight. Cisco Systems was a real, profitable category-defining company in March of 2000, not a speculative shell, and its stock still fell around 85% from its peak, taking 24 years to fully recover. Railroads transformed how humans move goods and people across entire continents, and investors still went bankrupt over building railroad track that the country didn't need yet. Electricity rewired the entire structure of industrial civilization, and utility holding companies still collapsed spectacularly in the process. The lesson embedded in every single one of these stories is not that the technology was fake. It's that even completely real, world-changing technology can still be overpriced by investors who get so excited about the destination that they stop asking whether they're paying too much for the ticket. So which story is Daniel actually living inside of right now? Nobody, and I mean nobody, knows for certain. Not the analysts on television, not the hedge fund managers, not the influencers posting screenshots of their gains. But there are specific things worth watching closely because they function almost like warning lights on a dashboard. Watch corporate earnings, especially the earnings of Nvidia, Microsoft, Amazon, and the other companies actually building this infrastructure. Because if their profits keep growing anywhere close to the pace of their spending, the valuations become easier to justify with each passing quarter. Watch the credit markets, specifically corporate bond issuance and credit default swap spreads for major AI infrastructure players, because debt trouble almost always shows up in the credit markets before it shows up in the stock market. Watch enterprise adoption data closely too, because a widely cited study out of MIT found that roughly 95% of corporate generative AI pilot programs failed to produce any measurable financial return at all, despite tens of billions of dollars in enterprise investment. That doesn't necessarily mean the technology doesn't work. It often means companies are implementing it poorly, bolting new tools onto old, broken workflows instead of actually redesigning how work gets done. But if that gap between spending and measurable business value doesn't start closing meaningfully over the next year or two, the entire justification for hundreds of billions of dollars in infrastructure spending gets a lot harder to defend to shareholders and boards demanding real returns. And then there's a completely different kind of warning light, one that has almost nothing to do with the stock market directly and everything to do with your actual electricity bill. Data centers already consumed somewhere around 4 to 5% of total electricity in the United States. And that share is projected to climb towards somewhere between 9 and 17% by the year 2030, with some regional grids, particularly in Virginia, already exceeding 39% of local consumption. A man in Virginia recently opened an electricity bill of $281, more than double what he'd paid the previous month, in a home he'd lived in for nearly 40 years, and directly connected the spike to nearby data center construction. Goldman Sachs projects the AI build-out could push electricity costs up by roughly 6% between 2026 and 2027, with an additional 3% increase layered on by 2028. This matters for the bubble question in a way that's easy to overlook, because rising public and political backlash against data centers, driven by real people opening real electricity bills, could eventually translate into regulatory friction, permitting delays, or local political resistance that slows the entire build-out down regardless of what Wall Street wants. Technology doesn't get built in a vacuum. It gets built inside communities, power grids, and political systems that have their own limits and their own patience. So where does that leave Daniel? Sitting there at his kitchen table with his coffee finally cool enough to drink, staring at a portfolio that's either the smartest financial decision he's ever made or a slow-motion mistake he hasn't fully recognized yet. Here's what he eventually lands on, and it's worth sitting with, because it's probably the most useful, least dramatic conclusion available in this entire conversation. The mistake isn't believing artificial intelligence is real, important, or transformative, because by almost every available measure, it clearly is. Enterprise adoption keeps climbing. Individual productivity gains on specific tasks are well documented and genuinely significant. The compute demand is not manufactured out of nothing. Chip shortages are real, and companies genuinely cannot get enough advanced processors to meet current customer demand. The mistake, if there is one, is treating every single dollar invested near this technology as automatically safe, simply because the underlying idea is exciting. A great technology and a great investment are not the same claim, even though our brains desperately want to treat them as identical. You can be completely right about where the world is heading and still lose a substantial amount of money if you paid too much to get there too early, or if you concentrated too much of your financial life into too small a handful of companies writing the exact same narrative at the exact same time. History offers a pretty consistent playbook here, whether you're looking at railroads in the 1800s, radio in the 1920s, or the internet in the late 1990s. The technology itself almost always survives and usually thrives, eventually reshaping entire industries exactly the way its earliest believers predicted. But the timeline is rarely as fast or as smooth as the excitement in the room suggests while it's happening, and the companies that get funded during the mania are not always the same companies that end up dominating the industry a decade later. Pets.com disappeared. Amazon, built during that same exact period, on that same exact wave of .com enthusiasm, became one of the most valuable companies on Earth. Both were funded by the same optimism. Only one of them justified it. So if you're standing where Daniel is standing right now, staring at a portfolio full of green numbers and a nagging voice in the back of your head, asking whether any of this is sustainable, here's the honest, unglamorous answer nobody wants to put in a headline. Nobody can tell you with certainty whether August of 2026 will be remembered as the early innings of the greatest technological transformation of your lifetime, or as the exact moment right before the excitement outran the economics. Both stories are currently true at the same time, sitting right next to each other in the same market, on the same day, inside the same stock price. What you can control is how much of your financial future you're willing to bet on any single narrative being completely correct, how closely you're paying attention to the difference between a company's story and a company's actual cash flow, and whether you're making decisions because of genuine research or because everyone around you seems to be making money and you're terrified of being the only person left behind. Because here's the thing, history keeps repeating back to us quietly, patiently, in bubble after bubble across generations. It was never really about whether the technology was real. It was always about whether the price you paid for it made sense once the excitement finally wore off. And by the time everyone in the room agrees on the answer, the trade that mattered has usually already happened one way or the other, without asking anyone's permission. Let's go a little deeper, though, because there's another layer to this story that most people scroll right past, and it might actually be the most important part. Nvidia isn't the only company caught up in these circular financing arrangements, and the pattern keeps repeating itself in ways that should make anyone paying attention slow down and read the fine print. AMD, Nvidia's biggest direct competitor, struck massive supply deals worth roughly $200 billion with companies like OpenAI and Meta, and as part of those arrangements handed over warrants, allowing those same customers to eventually acquire around 10% of AMD's total shares, for essentially nothing, a single cent per share. Think about what that actually means for a second. The chip supplier isn't just selling hardware to its customer anymore. It's giving that customer a meaningful ownership stake in the supplier itself, which means the customer now has a direct financial incentive to keep talking up how much they need that chipmaker's products, regardless of whether their actual end users are paying for enough AI services to justify the order. When a company that makes something and a company that buys that something start owning pieces of each other, the sales numbers stop being a clean signal of real-world demand and start becoming something closer to an internal accounting exercise dressed up as market validation. This is precisely the comparison Burry and other skeptics keep drawing back to the fiber optic build-out of the late 1990s, when telecom equipment makers like Lucent and Nortel extended enormous vendor financing to their own customers, so those customers could afford to keep buying networking gear, inflating both companies' reported growth numbers right up until the moment the whole arrangement collapsed, and took a huge chunk of the telecom industry down with it. Nobody is saying history repeats itself exactly. It doesn't. But it does seem to rhyme in oddly specific ways. And the people who lived through the last version of this story keep raising their hands to point that out. There's also a political and monetary policy dimension that deserves attention here, because markets don't exist in a vacuum separate from interest rates and government policy. The Federal Reserve, now under new leadership after Kevin Warsh's confirmation, has been holding its benchmark rate steady somewhere between 3.5% and 3.75%. A level that provides some cushion for risk assets, but nowhere near the rock bottom rates that helped inflate valuations between 2020 and 2022. Lower interest rates make future profits worth more in today's dollars, which is part of why growth stocks and speculative technology names tend to soar when borrowing is cheap and struggle when it isn't. The current rate environment sits in an uncomfortable middle ground, not restrictive enough to obviously choke off risk-taking, but not loose enough to guarantee the party keeps going indefinitely either. Add to that the fact that 30-year Treasury yields have been spending an unusual number of days above 5% this year, and you start to see why some analysts are worried about a squeeze from two directions at once, expensive government borrowing competing for the same pool of capital that technology companies need to keep financing their data center build-out. Let's also talk about Tesla for a moment, because it rarely gets mentioned in the AI bubble conversation with the same intensity as Nvidia, even though its valuation might actually be the more extreme example sitting in plain sight. Trading at a price-to-earnings ratio north of 300 times, Tesla's stock price implies a level of future growth and profitability that even many of its own bullish analysts privately admit requires nearly flawless execution for years into the future, across autonomous driving, robotics, and energy storage businesses that are still largely unproven at scale. Compare that to Nvidia's forward multiple in the 20s, and you start to understand why some analysts draw a distinction between companies whose valuations are aggressive but arguably defensible given current earnings, and companies whose valuations require you to basically assume a science fiction future arrives exactly on schedule. This is part of why lumping the entire Magnificent Seven together into one single bubble or no bubble verdict misses something important. These are 7 extremely different businesses with 7 extremely different relationships between their stock price and their actual current profitability, even though the market often trades them as a single unified basket during periods of extreme optimism or extreme fear. Now, here's something worth sitting with for a moment, something that has less to do with spreadsheets and more to do with human psychology, because ultimately markets are made of people, and people are not spreadsheets. Behavioral economists have studied market manias going all the way back to tulip bulbs in 17th century Holland, and the pattern that keeps showing up generation after generation is remarkably consistent. Retail investors, ordinary people without institutional research teams or insider access, tend to enter a speculative rally relatively late, often right around the point when the story has become so obviously exciting that everyone in their social circle is already talking about it. Institutional investors, hedge funds, and insiders often begin quietly reducing their exposure well before the peak, selling into the enthusiasm that retail money is providing. This isn't a conspiracy theory. It's just documented behavior visible in trading data across decades of market cycles. It's part of why the fear of missing out, sometimes shortened to the acronym FOMO, is treated by serious market historians not as a cute internet buzzword, but as an actual measurable psychological force that has moved trillions of dollars throughout financial history. Daniel recognizes this pattern in himself, uncomfortably, because he can trace the exact moment he started buying more aggressively back to a specific week when 3 different people in his life mentioned their AI stock gains, completely unprompted, at a dinner in a group chat. And in a comment section under a video he was watching for something entirely unrelated. That's not research. That's social pressure wearing the costume of financial insight. And recognizing the difference between the two might be the single most valuable skill any investor can develop right now. More valuable, honestly, than knowing the exact revenue projection for any individual company. So let's bring this all the way back down to something practical. Because abstract debates about bubbles and supercycles don't actually help anyone sitting at their kitchen table trying to figure out what to do with their own money. If you already own broad-based index funds, understand clearly that you are carrying more concentrated exposure to a handful of AI-linked companies than historical norms would suggest, and decide deliberately whether that level of concentration matches your personal risk tolerance, rather than discovering it by accident during a downturn. If you own individual AI stocks, separate in your own mind the difference between companies with real current profits and strong balance sheets, and companies whose valuations depend almost entirely on flawless execution of promises that haven't happened yet. If you're feeling the pull to buy more simply because prices keep climbing and everyone around you seems to be winning, take a breath. And ask yourself honestly whether you'd still want to own this position if the price had done absolutely nothing for the past 2 years. Because that question tends to cut through hype faster than almost anything else. And if you're feeling the opposite pull, the urge to sell everything purely because the word bubble keeps appearing in headlines, remember that some of the most respected voices on Wall Street, including analysts at Goldman Sachs and JP Morgan, are simultaneously making a well-reasoned, data-supported case that this rally still has real room to run, built on actual earnings rather than pure hope. Both sides of this argument are being made by smart, experienced people looking at the same data and reaching different conclusions, which should tell you something important about how much genuine uncertainty exists right now, no matter how confident any single voice sounds in a 30-second video. Daniel eventually does something that feels almost anticlimactic after everything he's read and worried about. He doesn't sell everything in a panic, and he doesn't double down and put his entire savings into a single chip stock either. He goes back through his portfolio line by line and asks a simple, boring, unglamorous question about every single position. Would I buy this today at this exact price, knowing everything I now know, or am I only holding on to it because of what it's already done for me? A few positions pass that test easily, companies with real earnings, real cash flow, and a business model he genuinely understands and believes in beyond the ticker symbol bouncing around on a screen. A few positions don't pass that test at all, and he trims them, not out of panic, but out of discipline. It's not a dramatic story. It doesn't end with him becoming spectacularly rich or narrowly avoiding total disaster. It ends with him simply becoming a slightly more careful, slightly more honest version of the investor he was 6 months earlier, which, in the end, might be the only reasonable outcome anyone can actually promise themselves in a moment like this one. Because the truth sitting underneath every bubble debate in history is almost embarrassingly simple. Once you strip away all the charts and the jargon and the 30-second video clips, nobody rings a bell at the top of a market to warn you it's over. Nobody sends a notification telling you exactly when the excitement has finally outrun the economics. The only real defense anyone has ever had, in any era, against any technology, is staying honest with yourself about the difference between a story you want to be true and a business you can actually verify with your own two eyes. Artificial intelligence may well turn out to be the most important economic transformation of this entire generation, reshaping industries the way electricity and the internet once did before it, and there is genuinely compelling evidence pointing in exactly that direction. But being right about the destination has never automatically meant you paid a fair price for the ticket, and history has shown over and over again in bubble after bubble, decade after decade, that those two questions deserve to be asked separately, carefully, and honestly, especially right before everyone around you agrees they already know the answer.